Twice in one lifetime, silver has run so far and so fast that grown men stood in line outside coin shops in the cold, convinced the whole system was about to change. And twice, right at the top, the same fear gauge that told you the panic had peaked went completely quiet. That gauge is not a price, it is a ratio. And right now, that ratio is telling a story almost nobody on the financial channels is willing to say out loud. So let me pay off the title before I earn another minute of your time. The number in the title of this video is a big number. It is a number that makes a comfortable retiree laugh and close the tab. And here is my honest read, up front, as plainly as I can put it. It is a real case. Not a promise, not a prophecy, not a guarantee I could ever make to you or to anyone, but a defensible, mechanically sound case built on one single engine that has swung wildly across the last 50 years and is nowhere near the extreme it has hit before. Everything else in this video is me proving that to you and being honest about where the case can break. The engine is the gold-silver ratio. It is simply how many ounces of silver it takes to buy 1 ounce of gold. And I want you to sit with what this one number has actually done inside the lifetime of most people watching me right now. Because this is the concrete fact I promised you, and it is the whole foundation. At the very peak of the last great precious metals mania, the ratio collapsed down into the teens. It took only about 17 ounces of silver to buy an ounce of gold. Silver was, relatively speaking, as expensive as it had been in modern memory. Fear was at a fever pitch, and silver had closed almost the entire gap with gold. Now hold that number, 17, because here is where it gets strange. Roughly a decade later, that same ratio had blown out to around 100. 100 ounces of silver to buy a single ounce of gold. In the span of about 11 years, this one gauge went from the high teens to triple digits. That is not a rounding error. That is the fear gauge swinging across almost its entire modern range, from one violent extreme to the other, inside a single stretch of one man's working career. I have spent a long time in the gold and silver world, and I will tell you, most people have never once looked at this number. They watch the silver price tick up and down, and they feel something in their gut. But the ratio is the thing underneath the price, and it is the honest measure of how frightened or how complacent the market has become about silver specifically. When the ratio is low, silver is loved and expensive relative to gold. When the ratio is high, silver is unloved, forgotten, cheap relative to gold. And that swing from the teens to 100 and back is the raw material of every three-figure silver argument that has ever been made. Here is why that matters for your money, and not just for a history lecture. Today, that ratio does not sit at 17. It does not sit at 100 either. It sits somewhere in the broad middle of its modern range, elevated above where it tends to settle over the long run, but nowhere near a genuine extreme. And the long-run gravity of this number is the key. Over decades, it has a way of pulling back toward the middle, back toward the 50s or low 60s, the way a stretched rubber band pulls back toward its resting shape. When it is stretched wide, silver is the cheap one. When it snaps back, silver does not just rise, it rises faster than gold, because closing that gap is silver outrunning the very metal it is measured against. Run that mechanically, and the big number stops looking crazy. You do not need a fantasy. You do not need the end of the world. You need two ordinary things that have both happened many times before. You need gold to grind higher, which the largest, most powerful buyers on earth are already forcing. And you need that stretched ratio to compress back toward its own long-run middle, the way it always eventually does. Put a rising gold price together with a ratio snapping from elevated back toward normal, and the math on silver does not require a miracle. It requires history to rhyme with itself. That is the entire case, and I just handed it to you in the first few minutes instead of dangling it over your head for 20. But I am not going to insult you by pretending this is a sure thing, because it is not. And the honest limit is the part the hype channels skip. A stretched ratio can stretch further before it snaps. It has done exactly that. The rubber band can go to 100 and beyond and sit there for years while impatient people give up. Silver is also far more volatile than gold, which means the ride up is stomach-churning, with sharp drops that shake out anyone who bought on emotion. And silver has a second job gold does not have. Roughly half its demand is industrial, so a serious global slowdown can lean on it in a way it does not lean on gold. If someone tells you three-figure silver is guaranteed, walk away from that person. What I am telling you is that it is a real, defensible case, and that the honest range of outcomes is wide. Both of those things are true at once, and only one of them gets airtime. Now, let me introduce you to someone, because a ratio on a chart does not knot your stomach, but a person does. Picture a man I will call Walt. Walt is a retired tool and die maker, the kind of man who measured things for a living and does not like being lied to. Years ago, Walt started quietly setting aside silver, a little at a time, not because a guru told him to, but because he trusted metal he could hold more than promises he could not. And Walt has lived through exactly the swing I just described. He watched silver approach that famous ceiling, feel invincible, and then watch the ratio blow out against him, while everyone told him he was a fool. Walt is the man I want you thinking about, because his fate and yours run on the same gauge, and I will come back to him. Here's the piece that turns this from an interesting chart into something with real force behind it. Twice now, silver has run up to roughly the same ceiling, decades apart, and both times it was stopped cold near the same level. The first time was at the peak of that old mania. The second time came about 31 years later, when silver climbed back up and once again stalled out near that identical ceiling before collapsing. Think about that. A generation apart, two completely different worlds, two different sets of buyers, and the metal stopped in almost the exact same spot. The base beneath that ceiling, the long shelf silver has been building, now stretches back the better part of half a century. And the longer a base like that, the more violent the eventual move when price finally clears it, because there is that much more coiled energy underneath. And there is a detail inside that old peak that almost nobody mentions, and it matters enormously to you as somebody trying to protect real money. That famous silver high from the old mania, the one everybody quotes as the number to beat, was a nominal number. It was the price on the ticker. But measured in real terms, adjusted for everything the dollar has lost since, that old peak was far, far higher than the plain number suggests. Which means silver has never once, in real purchasing power terms, gotten back to where it already went once before. Sit with that. The metal has a proven high in real money that it has not revisited in over 4 decades. The big number in the title is not asking silver to go somewhere it has never been. It is, in real terms, asking it to go back. Let me pause here, because if you are anything like Walt, this is exactly the point where the worry sets in. You are looking at your own retirement accounts, your 401k, your IRA, the savings you spent a lifetime building, and you are wondering how any of this protects you when the next shakeout comes. So let me speak to that directly, because it is the whole reason I make these. The most powerful buyers in the world right now are not retail traders, and they are not hedge funds. They are central banks, the very institutions that print the money in your wallet, and they have been buying physical gold at a pace we have not seen in generations, well over 1,000 tons a year, several years running, roughly double what they were buying the decade before. Gold recently overtook every other reserve asset, except the US dollar itself, to become the number 2 thing central banks hold. Read that again. The people who run the monetary system are quietly trading their paper for metal, hand over fist, and they are not doing it on television. Here is the part almost nobody tells retirees. There is a perfectly legal, established way for an ordinary American to do the exact same thing the central banks are doing, inside the retirement account you already own. You can move a portion of an existing 401k or IRA into physical gold and silver, real metal, without taxes and without penalties, through what is called a self-directed precious metals IRA. I put together a free retirement protection guide that walks through exactly how that works, in plain English. This is not just for insiders, and it is not just for the wealthy. If you have $100,000 or more in any retirement account, this is for you. If you are watching this on your TV, just scan the QR code on your screen. If you are on your phone or your computer, go to jeffreedguide.com. Take a look, then come right back, because the next part is where this really tightens. Now, why is the ratio elevated in the first place? Why is silver sitting there so cheap relative to gold, waiting? And here is where you meet the enemy of this whole story, the reason the compression case is not already priced in. Silver's price is set day to day, not in the physical market where real metal changes hands, but in the paper market, where contracts trade in volumes that dwarf the actual metal that exists. On those exchanges, a relatively small number of large players can lean on the price, and the machinery is built in a way that lets fear travel fast and physical reality travel slow. That gap between the paper price and the physical truth is not an accident. It is the business model of the desks that profit from your churn. Let me give you the cleanest proof of that, because it is one of the most quietly outrageous things I know, and it is completely true. A number of years back, during one of Silver's big runs toward that ceiling, the exchange that governs these contracts raised the margin requirements, the amount of money you had to put up to hold a position, several times in quick succession over a very short stretch. Nothing changed about the mines, nothing changed about industrial demand, nothing changed about the deficit. The metal in the ground was exactly the same the day after as the day before. But by changing the rules of the paper game, they forced a wave of selling, and silver fell around 30% in a matter of days. I have watched this exact setup play out more than once. Fundamentals do not move that fast. Rules do. And the people who write the rules are never the ones caught on the wrong side of them. That is the enemy you are up against, and it is why I get quietly angry when I see a retiree panic sell into one of these engineered shakeouts. Because that is the whole point of the shakeout. A frightened holder dumping real metal into a paper-driven dip is the paying customer of the desks that manufactured the dip. The silence about that on the financial channels is not an oversight. It is the product. They will give you 40 minutes on which technology stock to chase and not 40 seconds on the mechanism I just described to you. But here is the thing the paper game cannot fix, and this is the pillar underneath the whole compression case. Underneath the noise, the physical reality of silver is tightening, not loosening. The world has run a structural silver deficit for years now, meaning real-world demand for actual metal has outrun new supply, year after year, and another such year is widely expected. And unlike gold, silver gets used up. Gold is hoarded. Almost every ounce ever mined still exists, sitting in a vault or on a finger somewhere. Silver is burned. It goes into solar panels, into electronics, into the guts of the AI data centers being built at a furious pace, into 1,000 industrial uses where it is spread so thin across each device that it is simply uneconomical to ever recover. It is consumed and scattered and gone. So while the paper market plays its games with the price, the actual physical foundation underneath silver keeps getting quietly thinner. Paper can suppress a price. It cannot conjure metal that has already been soldered into a solar farm. And I want to be fair, because honesty is the only thing that makes the rest of this worth believing. There is a real headwind right now, and I am not going to hide it from you the way a pure cheerleader would. The Fed under Kevin Warsh has not been rushing to ease. The most recent decision came from a divided Fed, and the split was not toward the cheap money that typically lights a fire under metals. If anything, the pressure has leaned the other way, towards staying tight because of inflation. And a metal's one true enemy, historically, is a high real return on cash and bonds, a situation where just holding dollars actually pays you after inflation. When that happens, the shine comes off metal. That is the honest risk to this case, and you deserve to hear it stated plainly instead of buried. But watch what has actually happened lately, because it is the strangest and most important development of all. And it is the reason I lean the way I do despite that headwind. For decades, there was an iron rule. When real yields rose, gold fell. They moved opposite each other, reliably, like two ends of a seesaw. And recently that rule broke. Gold has climbed even as real yields stayed stubbornly high. The old inverse relationship, the one every trading desk built its models on, simply stopped working. When a correlation that reliable breaks, it is telling you something underneath has changed, that a new and more powerful buyer, the central banks, has walked into the room and is buying for reasons that have nothing to do with the yield on a bond. And if gold can defy its oldest rule and grind higher into a headwind, then the first half of the compression case, a rising gold price, is being supplied by the most determined buyers on the planet, whether the Fed cooperates or not. Now let me come back to Walt, because I promised you I would. Walt lived through the ratio swinging from the teens all the way out to 100, and it nearly broke his conviction. Here is what Walt understands now that he did not understand then. That swing was not random noise. It was the fear gauge doing exactly what it does, stretching to an extreme, punishing the impatient, and then, eventually, snapping back. Walt did not need to guess the day. He needed to understand the range, size his holdings so that no shakeout could ever force him to sell at the bottom, and own the real metal instead of a paper promise that can be margined out from under him. That is the whole discipline, and it is available to anyone watching, no special access required. Because here is what you have to understand about where we are in the story, and this is the part that separates the people who act from the people who wish they had. The smart money already sees this. The central banks are already positioned, buying in the quiet, not waiting for permission. But the mainstream, the pension funds, the financial media, your neighbor, the man on the business network, have not caught on. Silver is still the forgotten metal, the afterthought behind gold, the thing nobody at the dinner party is bragging about. That is what being early actually feels like. It does not feel exciting. It feels lonely and a little foolish, exactly the way it felt for Walt in the wilderness years. And by the time it is obvious, by the time three-figure silver is leading every broadcast and your own advisor is finally recommending it, the easy part will already be behind us. Nobody sends you an invitation to this. Nobody is going to call your house and tell you the ratio is about to compress. It happens quietly, and then all at once, and the people who understood the gauge beforehand are the only ones positioned when it does. So let me tell you the honest why now, with no fake deadline, because I do not do fake deadlines. The window where a decision like this is still cheap and calm and fully reversible is exactly the window when nothing feels urgent, which is right now. Once it feels urgent, once silver is roaring and the ratio is snapping shut, the calm, unhurried choice is no longer available to you. If you have $100,000 or more in a 401k or an IRA, I hold a free, no obligation, one-on-one educational web conference for people who have watched all the way to the end of one of these, like you just did. Mention that you watched the full video. We will walk through your actual situation, whether moving a portion into physical metal even makes sense for you, and there is nothing to buy on the call. If you are watching this on your TV, scan the QR code on your screen. If you are on your phone or your computer, go to jeffreedguide.com. That is jeffreedguide.com. Let me leave you where we started, with the two lines outside the coin shops, decades apart, and the fear gauge that went quiet at both tops. That gauge is the gold-silver ratio, and it has swung from the teens to 100 inside a single working life. It is stretched wide again now, silver forgotten, gold defended by the most powerful buyers on earth. I cannot promise you the number in the title. Nobody honest can. But I can tell you it is not as crazy as you think, because the machine that would produce it, a rising gold price and a snapping ratio, has run before, twice, in living memory. Walt already knows how this movie tends to go. The only question left is whether you understand the gauge before the crowd does, or after, because the invitation never comes. The compression just arrives.